Okay. All right. So the difference between operating, financing, and investing activities. Here's how I remember it, and I don't know if it'll help you, and that's actually stuff from like last chapter, right? The chapter 12 stuff. Although I guess we do look at the statements a little bit too.
Yeah, it was looking at the statements that I did find last week, and then this week it was a struggle for me
Right.
to associate.
So these will only come up, we only have to differentiate these things on the statement of cash flows. So the rest of the time, we're not really that worried about it. And so anyway, so the way I remember it is when I think of investing, I think of like, I could see why, because investing activities financing activities involve stock and loans, which seems a lot like investing, right? So is that why it like breaks your brain when you try to think about it? So
that actually helped a lot. Just that.
But that's not, but that's what it sounds like, but actually, right? So investing from a business's perspective is when the business buys assets, usually assets that are long-term in nature. So if you say, I'm investing in a piece of land, or I'm investing in a building, or I'm investing in some new equipment or machinery. So those are what investing activities really are. It's the purchase of assets that have a long-term nature that we're going to use to make money over many financial periods.
Okay,
so
that helps.
So from a cash flow standpoint, often investing activities are a negative because they often involve us putting money out to invest in these buildings or lands or things. The only time we actually make positive investing cash flows is if we were to say, you know what, I don't need this building anymore, and sell it off to somebody. But that's actually rarer than buying buildings, if you think about it. Like, you know, until you get to be giant like Walmart or something, then they're constantly building new stores and selling their old buildings and stuff. But so just from, I guess for me, it helps to think about this from the business's standpoint. To invest is to put their money into some other assets, big assets, and long-term assets. Financing, on the other hand, is this action of getting money, typically getting money to expand or run the business, right? So there's two ways we get money, actually three. One is we sell stuff to people. That's what our operating activities are all about. But the other is to borrow it, like borrowing it from the bank or by issuing a bond to people. And then the third is to sell a portion of the business to shareholders. Okay. So the financing activities that we deal with are either loans or issuing stock, selling a portion of the business. And so typically financing activities are positive cash flow, because we are saying, let's sell off 5% of the business for $1 million, and then we can use that $1 million to expand or whatever. So typically investing activities involve bringing in cash. I'm sorry, I just confused you. Financing activities involve bringing in cash through either borrowing or through selling equity in the business, issuing stock.
Okay, that helps a lot.
And then they're only a negative cash flow when we are either buying back that stock or paying off those loans, or when we pay dividends to our shareholders, right? We're saying, hey, you are a part owner of us. We made some money, so we're going to share a portion of that with the owners.
Okay. Thank you. That helps a lot, because I think I've been thinking of it from a personal finance, which is the total opposite of that. Okay.
Yeah, you think about it as an individual. When you invest, what you're doing is you're putting money into the stock of a business, right? And so now you're buying the asset, which is ownership in that business. But from their perspective, they're receiving cash in exchange for that. So so investing to you is purchasing assets, just like it is for the business. Investing for them is purchasing assets. Financing, if you were going to finance something, it would be like if you were buying a house, you'd say you were going to finance it, you'd be taking a loan, right? So it's the same thing. It just feels backward. And you'll find a lot of stuff in accounting, like perspective matters, meaning like, wait, am I the lender or am I the borrower here? which in real life is super easy to know. You know what you're doing. But in a book problem where you have to like read it for context clues, you have to like first say, okay, who am I here? Oh, I'm the person who's selling these services, so I need to record the revenue. As a person who would be buying those services would be recording an expense, right? So knowing where you sit in the transaction helps.
Oh, that helps a lot. Okay.
Which again is
Thank you.
actually easier in real life than it is in the class.
But
So I
that helps
see,
a ton.
I see we had a few more people sign in. So
Thank you.
I have a question.
Okay, go ahead. This is Daphne.
This is Daphne.
Okay.
So mine is more for next week's, the quiz access chapter 2.
The big fat one.
And that's for the the problem number 10, where it's talking about the description of the posting error. Like, I understand kind of what they're asking for, but at the same time, I'm not exactly sure.
Okay. Well, why don't I just bring it up and we'll take a look at it. So give me just a second. So for those of you late signing in, we're kind of doing it backwards. We're actually doing individual questions first, and then maybe at the end, if people want, I can still go through a little bit of a lecture or whatever you want to call it. But also know that that lecture, the lecture I would go through is the same video that is out there on my additional study resources. But it is nice when I go through it live because you can interrupt me and be like, whoa, wait, so wait, what does that mean? Like that. That was just me saying it the way I would if I was a student. Okay. Like, was like, whoa, wait a minute, what are you talking about, fool? All right. You don't have to call me a fool though, but you can. It won't hurt my feelings. I have raised 8 children through teenage years. Nothing you do can hurt me. Let's see. So I'm looking at, all right, so I'm on Quiz Access Chapter 2. And which number did you say, Daphne?
Number 10.
All right. If I seem a little manic, sorry, I just like, that's my way in the afternoon. I'm like, I get a burst of energy. So I don't know what it is. But then I go home, my wife's like, you need to go back to work or chill out or something until you're like more tired, you know.
It's the 8 teenagers that you've survived.
Yeah, I guess, yeah. And now I have grandkids and they exhaust me. So like the little one's killing me. Is this the one, Daphne, that I have on screen?
That is the one.
All right. Oh yeah, so people hate this one. I'm suddenly recalling this as one that people have no love for. Okay, so did you have a specific question or like, are you just like, I don't know how to start?
No, like, I understand it. So like, for example, letter B. So you have the 3,300 cash that's credited, but you're actually crediting it twice. So that would you only be saying that you, in essence, double deducted, you took the credit out twice, so you'd be $6,600
Right.
instead of the 3,300. But they're only saying, okay, we just want to say that one amount.
Yeah, well, so it's asking you, like, what is the difference between the debit and credit columns? So that's the first question they're asking us, right? So let me just read it. A $3,300 credit to cash is posted twice as 2 credits to cash. So difference between the debit and credit column. If the accounts incorrectly stated. Yeah, that is a little confusing. I don't like the way. So I don't know if they're expecting me to, I guess they're expecting me to make the leap that when I initially credit cash properly, that I also would have debited the appropriate account at that time, done $3,300 in each. But then the second time I accidentally credited only cash, and therefore my credit column would be bigger. Like, I feel like that's confusing. Which I feel like sometimes I want to drive out to California and find the McGraw-Hill people and punch someone in the nose, but I'm not a violent person, so I keep myself under control. So what was your question? Sorry.
Well, so when it's talking about identify the accounts incorrectly stated, so they only want me to say that it was cash when, I mean, there's always a second account that's affected by this.
Yeah, but they're not, we have no idea what that account is. And
Okay,
so
so I'm
we
just,
can't speak to that. Well, the part that confuses me is this idea that there's a $3,300 difference between the debit and credit columns. So I feel like either I posted cash, the credit to cash is posted twice as 2 credits to cash. And so that means I would have posted 6,600 in credits to cash, which leads me to assume I must have also posted 3,300 as a debit to something, probably an expense. So yeah, what I don't like about it is that it's asking me to assume something here instead of telling me. So yeah, so I guess all we really know is that we have 3,300 too much on our credit side, and that was to the cash account. And then the fourth column is like saying, okay, since credits reduce cash, right, and assets are reduced with credit entries, then having an extra credit entry of 3,300 would show our cash as lower than it should actually be. So our cash is understated.
so I believe on ours, if you select the, like where you put in the 3,300, for each one, it says plus 3,300, minus 3,300, and then there's a plus / minus.
Right here in this
Yes.
column.
On our question. Like that's the part that threw me.
Let me see if I can go back to this assignment and do a student view so I can see what you're seeing. It's one of the frustrations with this thing is that I can't always, so someone's asking me a question, I'm like, I don't know what you're seeing, So if I go student assignment view,
Oh, I'm sorry. It's in the column 4.
okay.
That's where it's a, I don't know. It's just worded so weird.
So well, so I'm not seeing where you're talking about this.
Yeah. So where,
Okay. So I guess what we're saying is on mine, so the numbers are different than yours, but it says $5,520 in credit to cash is posted twice. Okay. So that means I'm going to have $5,520 too much in the credit column. And then the question is, or then which account, cash account, and is my cash overstated or understated? Or in theory, I could say something's wrong with my accounts payable, but so we're talking about cash here. And so I just have to ask the question, would this make my cash, if I had this error of posting it twice in the credit column, would that make my cash account too lower than what it really is, or too high? And in this case, because credit reduces the asset cash, it's going to be too low. It's understated. Does that help or not? The reason people hate this question is the whole understated, overstated thing that confuses them.
so I was actually I was good on letter B. So look at D.
Okay. So on D, we have $2,610 debit to prepaid insurance accidentally posted as a debit to insurance expense. Okay. It doesn't say accidentally. I'm not sure why I threw it in there. Maybe it was done with ill intent, but I think it's accidentally. All right. So our intent was to debit prepaid insurance, which is an asset account, but instead we debited insurance expense, which is an expense account. So that will lead to not having any difference between the two columns, right? We meant to do a debit and we did do a debit. So if we don't have any difference in the columns, then we also won't have a column with a larger total. So then we have to identify the account incorrectly stated. And in this case, oh, I have to return to the question. Why it won't let me click? Okay. So in this case, I would say, well, my prepaid insurance account is going to be off, and my insurance expense account is going to be off. So both of those accounts will be wrong, because I wanted to debit prepaid insurance, 2610, but I didn't. I debited insurance expense. So my prepaid insurance is an asset. A debit to that account would have increased it. So by failing to increase it, I'm going to say prepaid insurance is understated. Oops, not by 5520. By 2610. And then insurance expense, which I wasn't supposed to debit, but I did. Expenses are also increased with a debit. So by debiting it when I shouldn't have, this one's going to be overstated. What was it? Insurance expense. So that's how I would answer that one.
Okay.
Does it make sense a little?
Yes, that made more sense now.
Okay. Yeah, I think these ones are kind of hard. Just because you have to like really, you really have to know, does a, with the given account I'm dealing with, does a debit increase it or decrease it? And then you have to like go from that to saying, okay, so since I did actually debit it, that should have increased it, but I wasn't supposed to. So you have to like say, it's going to show too high, or which means overstated. Okay. So any other specific problems to look at, or do we want to kind of go over some of the content more generally, like a little lecture of some of the content from the chapter?
Can I ask a quick question about that one about D? So
Yeah.
the column with the larger total would be the insurance expense?
No, neither column would have
We
a
don't
larger,
answer either. Okay.
because the only columns are debit and credit. So
Okay.
it's not asking which account, it's asking which column.
Okay.
And so since our intent was to debit and we did debit, then so the columns would still be balanced.
Okay. Thank you.
All right, well, I'm not hearing here. So I did want to, just in case people missed last week, real quick, I wanted to just make sure people knew, because like, well, first of all, I wanted to apologize because I typically post like on like Saturday night. I usually post like a what to expect next week, and I guess I just totally missed it this week. So I apologize for that, but a couple of announcements I did throw up there in case you missed them. This review sessions. So we have 3 tutors and they're all really good. Well, at least I know I've worked with Rise and Kylie. I don't know Cole very well, but they're super good, and they hold like review sessions. This is all like Idaho time that you can go to on Zoom if you want to. And these are people you can actually make like one-on-one appointments with as well. So in addition to like this meeting and making an appointment with me for things, we have these 3 tutors as well who have these meetings that are weekly. Here's their Zoom links, and then also their email addresses. You can email them directly. So just trying to make sure you have support you need there. And so that's in the announcements. And then I think that's the only one I wanted to really highlight to make sure everybody saw it. And then in the modules, I know I showed this last week, but I just want to show it again in case people didn't see last week. Right after the textbook information module, I have a module called Brother Fox's Helpful Stuff. In there, this just links to a Google Doc that has additional stuff that I've thrown together for each chapter. So like you can see like that problem, quiz access, chapter 2, problem 10, there's actually a video of me working it out. There's videos of all of these problems, 4, 5, 6, 9, and 10, because they were ones that people got hung up on in the past. So I created a video and then thought, well, I'll just save it and throw it here in case other people might find it valuable. So knowing that's there is helpful to some people. I also have this little debit and credit rules study guide, which is actually made by an accounting teacher here at Eastern Arizona College, where I worked before I started, and it was like saved on a jump drive when I got here. But it's good. It just shows all the different accounts or types of accounts, which side increases with a debit, which side increases with a debt credit, and then the normal balance for each. It's kind of a cheat sheet, but I don't like the word cheat sheet because it has cheat in it, and I don't want anybody thinking like, anyway. I know we're all adults. We can hear the word cheat and still not cheat, but anyway. So just be aware, I guess, that this is here if you weren't already. And then the other thing that I keep getting people asking me like questions about homework presentations. So I have this little homework presenters link in the helpful stuff, and it's broken down by your class section. Right? So I teach 2 sections. We have section 20 and section 32. But like, you can say, okay, you know, if, let me see if I can find somebody on here. Here's Erin. So Erin is signed up for week J, or well, for J, which is week 9 and week 11. So she can know which problem it is, chapter 5, problem 6, where she's supposed to post it in this discussion board, what date she needs to have it posted by. That's all here. And so that has everybody listed. Okay. So just wanted to make sure people know that's there, because sometimes you signed up for it and then the way the course designer set this up, that sign up discussion like locks. And so then you're like, oh, I didn't know I was supposed to write it down. So I just put it all together here for you. Anyway, so that's there. So any questions before I kind of try to get into a couple of concepts from the chapter, and then maybe a few examples? All right. Some of this will be very elementary to some of you. Others will be like, ooh, I'm glad you, why did it go to that one? Sorry, let me just scroll here. Okay, so like I said, it'll be elementary to some of you. Others might find this valuable, but just to kind of step back from what we were just working on. An account is just a record of increases or decreases to a specific asset, liability, equity, revenue, or expense. Okay. And so, and a general ledger is a record of all the accounts used by the company. So there's just some definitions of things we've already been using. So I just want to quickly review like what the types are. Asset accounts. Assets are things a business uses, okay, that it can own. So cash, land, buildings, equipment, supplies, etc. Anything you can own. And anything with receivable in its name, like accounts receivable or notes receivable. If you see receivable in the name, just know that that makes it an asset, okay? Receivable means someone owes it to you. And then prepaids, anytime you see prepaid in the name, that means something you've paid for in advance, but you haven't yet used. So it could be like prepaid insurance so you've paid for the next year's worth of insurance in advance, but you haven't actually got the coverage yet. Or prepaid rent. Those are assets. Liabilities are debts or money that you owe. So usually they'll have payable in the name, accounts payable, notes payable, but sometimes there'll be something like unearned revenue, which means unearned revenue is money somebody paid to you, but you haven't yet earned it. So you kind of owe them their money back, or you owe them the services they paid in advance for. Equity is our common stock and revenues that increases our equity, and then our dividends and expenses, those decrease our equity. All right, so again, this is just a review from the last chapter. We know that assets equal liabilities plus equity, and we know that common stock minus dividends plus revenue minus expenses is our retained earnings. All right, so debits and credits. So if you've anybody here ever worked in banking? Well, that's good, because people who work in banking get really confused because it feels backward to them, okay? So well, the first thing you have to get rid of in your brain is the idea that debit and credit mean something more than left and right. I think some of us, because of bank accounts, have learned to think of like a credit as a good thing and a debit as a bad thing, in the sense that, like, you know, debit means my money's going down because I used my debit card. But that can get really confusing. So just think of debit as meaning left and credit as meaning right. We enter debits on the left and credits on the right. And some accounts are increased. Whoops. Whoa. That was weird. Some accounts are increased with a debit and decreased with a credit, and others are the opposite. So again, I know this is review for many of you. So it's easy to remember if you remember this basic accounting equation, that assets equal liabilities plus equity. So asset accounts are increased with a debit, decreased with a credit, and then liability and equity are the opposite. I just remember that because they're on the other side of the equal sign, they would respond or act opposite how assets do. So then if I can just remember assets increase with a debit, decrease with a credit, and that liabilities and equity are the opposite, that helps me memorize all of these. Also recognize the normal balance is always the side of the account that increases the account. So the normal balance is a debit balance for assets and a credit balance for liabilities and equity accounts. Also recognize that with equity accounts, it matters if the account increases or decreases equity. So those accounts like common stock and revenues that increase equity, they will decrease with a debit and increase with a credit. And then those accounts that decrease equity, dividends and expenses, will be the opposite. So they'll increase with a debit and decrease with a credit. Honestly, in the end, you just have to kind of memorize this. Like, you've got to know this, and please put in the effort to memorize it and be able to apply it, because it won't go away. It'll be all through here, all the way through this class and all the way through managerial accounting. And if any of you are actually accounting majors, then when you take intermediate accounting, I mean, it never goes away. Debits and credits, I still use them daily when I'm doing accounting type work.
I have a quick question.
Yeah.
So dividends, like the company pays out dividends. So that's usually always going to be an increase in debit. I mean, is it ever on the credit side?
Almost never.
That's
So
okay. Expenses would be the same too?
Yep. About the only time you're going to credit a dividend or a debit account is if you're correcting an error because you accidentally, did a dividend that you shouldn't have or something. So you're undoing it. And then we'll talk about closing entries later, but that's it.
Okay.
Almost always you're debiting dividends and expenses, and almost always you're debiting revenues, or crediting revenues. Like, that's just.
And common stock too. Or I guess that one kind of goes down sometimes.
Right, because you issue stock and then you buy it back and stuff like that.
All right.
Same with like assets. It's normal, like with cash, for it to go up and down and to have cash,
Okay.
But with expenses, they just accumulate until the end of the month, and then we close them, like I said, and that resets them back to zero. So
okay.
Yeah, that's a good pickup. That's a good thing to notice. That means if you're crediting an expense, you should be like, is this right? You're right. Like I always say, like, learning those skills is like when you're, how like moms are better at sniffing milk to know if it's bad or good than dads. I don't know why. Maybe it's not in your family, but I always ask my wife, is this okay? I call it your sniff check, right? So when you recognize something's off a little. And so
Right.
that's a really good skill. Say, like, I know that if I'm crediting an expense or a dividend, that's kind of weird, and I need to double check.
Okay. Thank you.
Sorry, that was a really long answer to a short question.
That's okay. I needed that answer. So.
Which is why my children would rather just be punished than have dad, talk to them about it. They're like, oh, for the love of just punish me. All right. Poor kids. All right. So a journal entry involves debits and credits. And anytime we do a journal entry, they have to balance. Okay. And then a ledger, this is called a T account ledger. It's how we figure out the balance of an account. And so you'll notice this has a list of all these transactions on here. Some of them are debits and some of them are credits. So to find the balance of the account, what we do is we add up the debit side and we add up the credit side, and then we subtract the smaller side from the larger side, and the balance will end up being on that larger side. So we'd say this side totaled 36,100, the debit side. The credit side totaled 31,300. We subtract 31,300 from 36,100, leaving us a balance of 4,800 on the debit side. And so what we would actually say is the cash account has a debit balance of 4,800. All right, so this is what a journal entry looks like with a bunch of red arrows, but this is still what a journal entry looks like. So this transaction, it looks like the owner put $30,000 into the business in exchange for common stock in the business. Okay, so we're showing a debit to cash because cash, and you'll see that we always put the debit entry first, and then we're showing a credit to common stock, and we always put the credit entry second. And so for me, I find it like helps me to sort of try to translate a journal entry, if I see one, into like plain English, to say, okay, the cash is going up, and the common stock, which is an equity account, is also going up. So this must be, the business is issuing common stock in exchange for $30,000 in cash. And then this one, we would see supplies, which is an asset, is being debited, which means it's going up, and cash, which is an asset, is going down. So without even reading this, I could say it looks like somebody's just buying supplies for cash. So this is these are two different journal entries, okay? And in the olden days, they recorded these by hand in a book. Now we have software that does most of the heavy lifting for us. And then this is called a ledger. So earlier I showed you a T account ledger, which is one way of tracking the debit and credit balances of the account. And then this is another type of ledger where it shows the transactions, the debit, and then the balance. So you can see this is the cash account. So cash was debited 30,000, and then it was credited 2,500, giving us a new and so the balance is, in this case, a debit balance because it's an asset account. Then it was credited 26,000, leaving us with 1,500. Then it was debited 4,200. So on these type of general ledgers, you'll see like a balance that's constantly updated with each entry.
Can I ask a funny question? Then PR is just the page reference, right?
Correct, yeah.
Okay, thanks.
And again, so these almost don't exist anymore because everything's done with computers. But in the olden days, when my pappy was an accountant, even though my pappy was a firefighter, but what they would do is they would write the journals. They had a journal section of the book. It was an actual book, and they would write the journal entries, and then there was like a tabulated section in the back, one for each account, a ledger for each account. So they would go to that ledger and say, so they would do a journal entry, debit cash 30,000, credit common stock. Then they would turn to the cash page and they would write a debit for $30,000 and then reference the page that they had written that journal entry on. And so that way, if they were looking at, if they're looking at the transaction here, they would know to turn to cash to find where they had recorded it. And if they were looking at the cash page, they would know to turn back to the, what page the journal entry was on. So again, long answer for a short question, but yes, that's a page reference. But now we do almost everything with computers. And so like if I'm using QuickBooks and I go in there and I'm like, oh, there's this debit entry here, I would just click on it and it would take me back to the journal entry. So much better. It's like magic. Digital magic. All right, so that's just another thing on posting journal entries, which I think I've talked about at length. So I'm going to move on to some examples. Okay, I think that will be better and more valuable. All right, so we call this double entry accounting because there always has to be debit and a credit for any journal entry. And the debits and credits have to equal each other. So another tool, another sniff check to learn is like if my debits and credits don't balance, then something's wrong, right? You can just tell, and then you have to go back and look at it another time. So this is the steps they give you, which is step 1, identify the transaction in source document. Step 2, analyze the transaction using the accounting equation. Step 3, record the journal entry. Step 4, post the entry to the ledger. Okay, so I'm going to take you through a few examples, and after a few, I'll put it to the group if we want to go through more, because I've got like, I don't know, 15 or 20 of these examples, and they start to get, although sometimes we can go faster once we get comfortable with them. All right. So the first transaction is, fast forward, the company receives $30 in cash from Chaz Taylor in exchange for common stock. So then we analyze it and say, what's happening? My asset cash is increasing and my equity common stock is increasing. Then we're ready to record, because we can say, okay, cash is an asset, so an increase to an asset would be a debit. So I'm going to debit cash, 30,000. And then common stock is an equity. So an increase to an equity is a credit. And now I've made my journal entry. And then step 4, I post it to my ledgers. And like I said, for simplicity, there's using T account ledgers here to show cash now has a debit and common stock now has a credit of 30,000. So there's our first transaction. Transaction number 2, we pay $2,500 cash for supplies. So again, an analysis would say, okay, so supplies and asset is going up and cash and asset is going down. So since an asset going up is with a debit, I'll debit supplies. And since an asset going down is a credit, I'll credit cash. Then I post it to my ledgers. Like cash, we can now see has two different entries in the ledger. The first one that increased it by 30,000 and the second one that decreased it by 2,500. So again, if you have a question about something I'm saying, feel free to just interrupt, because there's no way to really raise your hand here and I will not get offended. But I'm just kind of stepping you through the process. So there's a part of their process that I think 3A is to record the journal entry. And then for my brain, 3B is to make sure my debit and credit entries balance. Like I always just kind of do that real quick. This one's easy, right? Because they're just 2,500, 2,500, but sometimes they're a little more complex. All right. Transaction 3, we purchase equipment for cash. So they pay $26,000 cash for equipment. Again, I have an asset equipment going up and an asset cash going down. So assets going up are debits. So I'll debit equipment, 26,000, and assets going down are credits. So I'll credit cash, 26,000. I balance, then I post them to the ledger here, the T accounts. So we can actually see like our cash account is getting pretty low, right? We had 30,000 in debits and 28,500 in credits. Hopefully we get some cash pretty soon. All right. We have so little cash that we're going to purchase supplies on credit. So transaction 4 is to purchase supplies on credit from a supplier. So I would say, what's happening here? I have an asset called supplies going up, but I have a liability because I'm purchasing it on credit. I have a liability called accounts payable also going up. So then I have to say, okay, assets go up with debits. So I'm going to debit supplies, and liabilities increase with credits. So I'll credit accounts payable. Finally, we're going to earn some money here. Transaction 5, we provide consulting services and we immediately collect cash of $4,200. So I have an asset cash going up, and then my equity is going up now because I earned revenue. So revenue is going to go up by 4,200. So again, I remember the rules. Assets increase with a debit. Revenues also increase with a credit. Revenues increase with a credit. And so I'll debit cash 4,200 and credit consulting revenue, and then post them to the ledger. You'll notice when we post them to the ledger that if I debited it here in the journal, then I'm going to debit on the T account ledger. And if I credited here in the journal, then I'm going to credit on the T account ledger. You got to keep that straight. It's pretty easy once you learn how to do it, because you're always just debit for debit, credit for credit. All right, now we pay an expense in cash. So we pay $1,000 cash for December rent. So cash is going down. So that's an asset. So we would be crediting cash. And then the expense, this is a little confusing because our expense is going up, which is a decrease to our equity. Okay, so that can sometimes confuse people, because here it shows -1,000 as if our expense is going down, but it's our equity that's going down because our expense is a negative to equity. So I'm going to debit rent expense, credit cash, and then post them to the ledger. We have more expenses in cash. We pay $700 for employee salary. Same thing. We debit the expense, credit cash. This is one of the most common types of transactions in accounting, to debit an expense and credit cash, right? Because you think about a lot of what you do in business is you're paying expenses. Okay, so debit salaries expense, credit cash, and then post it to the ledger. All right, so here we provide consulting services for $1,600, and then we rent our facility for $300, and then we bill the customer $1,900 for the services. So we're not getting cash yet, we're billing the customer. So when we bill a customer, we record that as an asset called accounts receivable, or money owed to us. And then we have two different types of revenue. So here we have, this is called a compound entry, where there's more than just one debit and one credit. Here we've got two credits and one debit. So our accounts receivable asset will be going up by $1,900, since that's what we billed the customer. So we will debit accounts receivable by $1,900, and then our consulting revenue will be going up by $1,600, and our rental revenue will be going up by $300. And so then my step 3B actually comes in handy when I can say, we'll do these balance. I have $1,900 on the debit side, $1,900 on the credit side. I'm good. So then I'll post those, the debit to accounts receivable and the credits to the two revenue accounts, and move on. All right, so question, I have several more of these. Do you find them valuable, like me going through them, or would you like to skip past all these transactions? It would only take an extra few minutes to go through the rest of them, but I just didn't want to bore you if you're like, I already understand journal entries, so quit wasting my time like that. I don't know what no votes means, so I don't know.
I would say go ahead and go through them.
Okay.
Yeah.
Okay. Okay. All right. Transaction 10, a partial payment of accounts payable. So here we're going to pay $900 of our accounts payable from our earlier transaction. So if I'm paying money out, my cash is going down. I have a -900 to cash, and my liability is going down because I'm paying it off. So then I'd have to say liabilities decrease with a debit and assets decrease with a credit. So I'll debit accounts payable 900 and credit cash 900, and then post those to the ledgers. Payment of a cash dividend. So we're going to pay $200 in dividends out to the owners. So when I pay a dividend, cash is going down, and then dividends, like expenses, are equity, they decrease our equity. So again, we record dividends with a debit. That means our dividends going up, which is decreasing our overall equity. Okay, so I debit dividends and credit cash to show the payment of that cash dividend. All right, step 12 or transaction 12, we receive cash for future services. So this is like our customer paying us, but we haven't earned it yet. So our cash is going up, and then because we haven't earned it yet, we have to record it as a liability called unearned consulting revenue. And so our asset cash gets debited because it increases by 3,000, And our liability, unearned consulting revenue, also gets increased with a credit. So we debit cash, credit unearned consulting revenue. All unearned revenue means is money that we were paid in advance but haven't yet earned. And so we record it as a liability because we either owe those services to the client, or if we can't provide the services, then we would owe them their money back. Here we pay some cash for future insurance coverage. So our cash is going down and our prepaid insurance asset is going up. So we would debit the asset prepaid insurance, it's increasing, and credit the asset cash. Here we
Can
purchase.
I ask a question about that?
Yeah,
How do we accrue that though? Like when we, right?
actually
Yeah,
receive a month's worth of insurance coverage.
yeah. What's the accrual?
Yeah, so we're going to learn about adjusting entries in the next chapter.
Okay.
And
All
so
right. Okay.
it's everybody's least favorite chapter, just so you know.
So I have another question. With
Yeah,
almost every transaction, it helps me to kind of look at the chart of debits and credits. Would you recommend, like, if we're taking our test, like, you know, because we have to start with a blank piece of paper, right? Can we, once we start our test, can we just jot down our, you know, these little charts and formulas and stuff to kind of refer to the whole time, or what would you
yeah,
suggest?
so absolutely. So as long as you're starting with a blank piece of paper,
Mhm.
and I recommend, even though I don't know why they have it, but I recommend just showing your blank sheet of paper to the camera,
Okay.
right? That's just another way of saying, like, I'm above board here, and then immediately writing down, you know, make yourself a little debit and credit chart, if that will help you.
Yeah, I
Because-
think it would, because I look
Yeah,
at it all the
that's
time.
completely allowable.
Okay.
You know, the thing
I
that's
have a
kind of,
question.
yeah,
Can we also use, let's say Excel, so to use like asset, liabilities, and equity, and then do our calculation there?
yes, you can use Excel, but again, you recognize your screen's being recorded, right? So you need to, it needs to be a blank Excel. You can't like open an Excel that's got stuff on, you know, an extra tab or something.
Okay.
Yeah.
Thank you.
Yeah, what's hard for me about them having this be completely closed book is, like, nothing in accounting is ever a completely closed book. Like, I all the time Google stuff, right? That being said, I do think debit and credit, like knowing those like down pat, like your times tables, is really valuable. And so I get why they're trying to get you to study, learn it enough that you could like write it out, like you said, by hand, because that means you'll have that tool now in your head always. Or well, at least as long as you need to remember it, which is through the next couple classes.
And
Anyway,
then I haven't looked either, but like calculator too, is that one of the things?
yes,
If you don't
Yep.
want to go through the Excel, okay.
yep, a calculator, Excel, and scratch paper. That's what you're
Now
allowed.
we have to remember all the equation, like return of assets, debt ratio and stuff. Okay.
Yep.
So
Yeah,
we can't use formulas.
You-
Because I think ROA is in there, right? In Excel, isn't it?
if you can use the function in Excel,
Oh, okay. I
but
just heard angels sing. Okay.
but I would beware sometimes, you've probably seen this if
Huh?
you've used Excel a lot, that Excel will often carry things out to more decimals in it than like what you punched into your calculator.
Uh-huh.
And so sometimes there's slight rounding error. You know, I've seen that with these, you know, so like just on your homework, but like there's no reason you can't use Excel functions if you're comfortable with them.
Okay.
All right. All right. Number 14, we purchase supplies for cash. So our supplies assets going up, our cash assets going down. Okay. So we're going to debit supplies and we're going to credit cash. Payment of an expense in cash, our expense going up and our cash is going down. So we're going to debit the expense, credit cash. Come on, we've already seen that. Okay. 16, we pay another expense in cash. Same thing. We debit the expense, credit cash. So again, you'll get super used to that one. Same with like revenues and cash, then you're debiting cash and crediting the revenue. Like that happens over and over in business. All right. So at the end of the month, we go, hey, look at this. I've got a record now in my ledger, this is my T account ledger, of all of these transactions. And then I can calculate the balance just by adding up each side, subtracting the smaller side from the larger side, and getting a balance. So this is pretty handy. Now I know the balance of each of my accounts. And then I can summarize those balances in what's called a trial balance. A trial balance has all of the accounts listed with their balances, either debit or credit. You'll notice that a trial balance is always in this same order, where it has all of the assets, then the liabilities, then the equity accounts, then dividends, then revenue, then expenses. So I always call this financial statement order. The balance sheet has assets, liabilities, and equity. Then the statement of retained earnings has dividends and retained earnings. And then the income statement has revenue and then expenses. So that helps me remember what order to put these in. Anyway, so that's how they're laid out. Your trial balance must balance. Your debits have to equal your credits. What's super cool about this is once you have a trial balance, creating financial statements is super easy. So here's my income statement. I would just pull my revenue off of the two revenue accounts. So I have my consulting revenue and my rental revenue, which gives me my total revenue, and then my expenses. Again, these are the numbers right off of the trial balance. So I've got my two revenue accounts and my expense accounts. So my revenue minus my expenses gives me my net income. Once I've done that, I can create my statement of retained earnings. Because it's a brand new company, their retained earnings at the beginning of the month were zero because they didn't have any because they're brand new. We add our net income, which we calculated right here on the income statement. We subtract our dividends, which were right there on our trial balance, and we end up with our retained earnings at the end of the month. Yay. And then once we've done that, we can create our balance sheet. We pull our assets right off of the trial balance, our liabilities right off of the trial balance, our equity is our common stock, which is on the trial balance, and our retained earnings, which we've just calculated. And that will give us our total equity. And then our total liabilities plus our total equity should equal our total assets. So the trial balance is cool because it like puts all of that together for us in one place, and then we can easily make the statements. Again, in real life, all I have to do is, if I'm in QuickBooks, I click on reports and click income statement, and it makes it for me. Or I click on reports and click balance sheet, and it makes it for me. But they do want to make sure as accounting students, business students, we at least know the process by which these things are made. That way, if there's ever an error, it's easier to find it. Okay. Two other little items. The debt ratio is our total liabilities divided by our total assets. This helps us understand how much debt risk we have. So think about this. If our liabilities equals our assets, then our debt ratio would be 1. If our total liabilities are greater than our total assets, then our debt ratio would be greater than 1. And if our total assets were greater than total liabilities, then our debt ratio would be less than 1. So the higher the ratio is, the more debt risk a company has. So we want to see this ratio be lower if possible.
So the easiest place to grab your total liabilities and total assets would probably be the balance sheet.
Yep. Yep,
Okay.
because we can just look right, like, here's total assets and there's total liabilities.
Okay.
So this company, 9,200 in liabilities and 42,395 in assets, they're going to have a pretty small, right? Their debt ratio is going to be like, it's about, what is that? Almost like 1/4. So like a little better than 1/4, like 0.28. Well under 1.
Okay.
So we have Costco's debt ratio versus Walmart's debt ratio. So we can see that Costco, that neither of them have truly unhealthy debt ratios, okay? But Walmart's is healthier. They have less debt relative to their assets. Okay, that was a lot. So sorry for that. I hope it wasn't painful. And even if it was painful, hopefully it was the kind of painful that like is, you know, like running where you're stronger for doing it or whatever. So I guess before we finish up, is there any other things, any other questions I can answer for you? That sounds.
Sorry,
Go
one
ahead.
more. Plant assets, I saw that referenced a couple times. What does that mean? Just any assets you have?
Yeah, so that's a good question. So as we move into what are called some balance sheets separate out current assets, which are assets that are more liquid, more easily turned into cash, and plant assets, which are equipment, buildings, land, those less liquid assets, things that are long-term assets that the only way to turn them into cash would be to list them for sale or something like that. And they're typically assets that are used for manufacturing or doing the work of the company, as opposed to like consumable assets like supplies that we're using up. Does that make sense?
Yeah, so supplies would be more liquid assets.
Yeah, that's part of our current assets.
And cash too? Cash,
accounts receivable. So the typical rule is a current asset is any asset that is either cash already or that we intend to either consume, like supplies, use them up, or convert to cash, like accounts receivable, within a year. And anything that we don't intend to convert into cash within a year or use up within a year is long-term. Usually we call those plant assets. And we'll learn more about it in a future chapter as well.
Okay, thanks.
You're just ahead of the curve, Kendra. It's a good thing. All right, so why don't we finish up with a prayer? Is anybody thinking, you know what I need today? I need to say a prayer.
I can pray.
I saw you unmute, Aaron, so I thought that, okay.
I can pray. Our dear, most gracious Heavenly Father, we thank thee for the opportunity to gather together tonight, Father, and to learn more from Brother Fox and to increase in our understanding of the accounting principles that we are trying to learn at this time. Father, we pray that we will be able to increase our understanding and increase in our preparation as we prepare to take our test in the upcoming weeks. And we pray, Father, that all in attendance will have the time that they need to, Father, to study adequately and to prepare. Father, we ask at this time for a quickening of our understanding. We are so grateful, Father, to have been able to be here and to have been able to learn. And we say these things in the name of Jesus Christ. Amen.
Amen. All right, have a great night. Remember, Heavenly Father has commanded you to seek learning. So if you're seeking learning, it's fully acceptable for you to expect divine help. Sometimes though, if you're just seeking getting a grade but don't really want to learn, that I don't think he's commanded us to seek getting good grades with putting in as little effort as possible. So I've tried to pray for that myself a few times. Remember, any college professor has been to lots of college, right? But for real, if you're seeking learning, it's fair to expect heavenly help. because he's commanded us to seek this learning. Anyway, have a great night.
Thank you.
Bye,
Thank you
everybody.
so much.
Bye.